Let's turn to the markets because we are seeing more selling here. Our next guest sees tariffs as a main market item to watch in 2025, also keeping an eye out for signs of weakness and vulnerability around AI. Joining us here at Post 9 is David Bahnsen, founder and CIO of the Bahnsen Group. Welcome. So are you feeling a little more cautious about the market to start the year?
I've been cautious for a while just from a valuation standpoint. My concern, honestly, is not bond yields. I think that the 10-year going higher can be a very good thing for stocks if it's because of real growth. You know, the 10-year is up 100 basis points and inflation expectations are up 12 basis points. That's a lot of real growth increase. That can be good for stocks. The problem is there's a threshold at which it starts to weigh on those already high valuations.
But it's, good for growth in what way? It means higher mortgage rates. It means higher credit card rates. There's already a report today in the FT about bankruptcies going up in the U.S. because of higher interest rates. So there's the rate problem for the economy, and then there's inflationary pressure.
And those are two totally different things. Growth is not inflationary. So that's my biggest difference over the last several years in the big narrative around inflation is the belief that people having jobs causes inflation. It doesn't. It never has. More supply, more growth is good for inflation. It puts downward pressure as we produce more goods and services. Issue about borrowing rates is an issue, and it's why the Fed has to control that at the short end of the curve. There is nothing they can do at the long end of the curve. But again, if you start getting much north of 5%, I think that does weigh on expectations.
You think that's the threshold that you mentioned earlier, 5?
Yeah, and again, it's not a perfect science, but I believe that we have not seen it go above 5, and everything in the 4s so far has been pretty benign. You have stocks up 20% plus 2 years in a row with a 10-year mostly over 4%.
Right. You mentioned the Fed can't do much about the long end. Can Congress? And do you have confidence they will?
Congress can do some bad things for the long end. There's not a lot of good things, nor is there a lot I'd want them to do. Look, the Fed can do stuff with quantitative tightening and easing, but I don't want that either. They've really curtailed a lot of the tightening. That's really meant to more manipulate the long end. The Fed funds rate is being cut and the long end has gone higher. You're 35 basis points spread right now in the 210. That's very healthy. That's indicating a good economy. But again, with valuations at 22, 23 times, there's vulnerability.
So you think it's more of a positive signal about growth than, say, a negative signal about foreign demand or worries about our fiscal sustainability?
That's right. That's right. If people are worried about fiscal sustainability, you don't get 4.6. You get something much higher than that. This is very marginal increase and still within a range that we were at 2 years ago. We were at 5%. Right. So I just don't think that there's anybody. And again, inflation expectations would tell you if I were wrong, because the tip spreads would be blowing out, and they most certainly are not.
Still, though, it's the worst. Isn't it the worst return on a 10-year in an easing cycle that we've seen, maybe ever?
Yeah, the difference is it was positive, where in 2022 you got double-digit negative. And so when you have a protective coupon, it helps a great deal. The idea that the 10-year was at 3.8, went to the 4s last year, and you still had a positive return in treasuries, that's what the benefit of a long coupon cushion is.
So you're worried about equity valuations right now, you said. But what were valuations when we started the year last year? They were elevated as well.
That's right. It's not a timing. It's not a timing mechanism. Yeah. And so, look, the top 10 stocks a year ago were 28% of the market. Now they're 38% of the market. You're at a 1.1% yield in the S&P, the highest price to book in history, and you're at 22, 23 times. It doesn't mean this stuff collapses in 2 months or even 6 months, but it's vulnerable, and the risk reward is what I'm referring to. That's why we're just not index investors. We prefer to be bottom-up and selective.
We're about to hear from President-elect Trump at Mar-a-Lago, which is amazing that we have this news conference now from the President's Resort and Country Club happening even before he gets inaugurated with all these billion-dollar investments. $20 billion we're expecting, had $100 billion from Masa a few weeks ago. Does that change your view as an investor?
No, I'm not surprised. If you remember back in 2016, even with the same gentleman and same company with SoftBank, we saw a similar announcement, although that time it wasn't Mar-a-Lago. It was down at Trump Tower, right? I think that you're going to see a lot of this. There's a lot of people currying for position with the administration, but data centers are something people should be investing in. Foreign capital, domestic capital, we're heavily invested in the space. That's just a great opportunity. I don't think it speaks to something unique about the administration. That opportunity is there anyways. The difference is President Trump wants to use it as sort of a selling point for America. And I thought your points earlier were fascinating. It really is somewhat contradictory to blocking of this steel deal. Do we want foreign capital or not? I'm one who just finds it mystifying that both President Trump and President Biden have opposed that deal when there are solid U.S. companies with labor conditions that people are agreeing to, national security issues that are addressed, and foreign capital wants to come in. we should want that investment.
Even from China? I mean, that's the problem.
Well,
how do you start?
But this isn't China, though.
Right,
so,
exactly.
So let's just start with ally nations first. Japan is an ally nation, and even as we saw with SoftBank, this president has no problem taking equity capital from a Japanese company. So why is it different with Nippon Steel?
I guess our point is that countries don't come with a label, either green or red. And so how you parse the pros and cons, it gets complicated.
Yeah, but I think that there is a dividing line between ally nations and adversarial. And so to the extent we're right now talking about an ally nation, there's gray areas with China. The big controversy about farmland purchases, for example. They have equity stakes in a lot of American technology companies. I at least acknowledge that's more gray and ambiguous. With Japan, it really should not be.
No, but I think the point that Eamon made was interesting that, there's a difference between just foreign direct investment, building data centers, investing in AI companies, and just outright buying a great American historic company like U.S. Steel.
Well, there's a big sentimental difference. Okay,
exactly.
there's a sort of iconic brand association. The fact that the company is called U.S. Steel
just talking about
doesn't help with it. But look, this is a company that is not attracting American equity capital, and it's going to protect jobs. And the people on the ground in Pennsylvania desperately want the money coming in.
I know the local mayors are in favor. Even the union workers are in favor, just not the union head, which gets back to the whole Biden point. But there is this view, when I asked about how you feel about it as an investor, that animal spirits are waking up. And we've shown a number of confidence surveys. I showed one in the last hour from sector analysts that expect companies to continue to hire and that the mood is better from small business to big business because of a pro-growth agenda coming out of Washington, which is a very different place than we've been.
It's deregulation is the biggest issue. You saw NFIB optimism for small business and CEO confidence skyrocket up in 2016. Now it's done it again. One of the things complicating it now, though, is the Fed was tightening in 2017, and they're loosening now. And I wonder how much of small business optimism is increasing, not just because of hopes for Trump tax cuts and deregulation, but the idea that the cost of capital may be coming lower. That's got to be a factor as well.
Mike Santoli's with us as well, listening in. Mike, I want to bring you in.
I think in general, we have a high expectations among investors for 2025 market performance with low conviction in the near term about the tactical setup and whether, in fact, the policy mix is going to be favorable from the jump.
To Mike's point about the near term versus the long term setup, whether all of these policy complications we're discussing will make 25 more fraught than last year.
Yeah, I think it enhances volatility. And there was very little day-to-day volatility last year. It was, I think, only 18% of days that had an up or down 1% day, where we had been having years at 40% of days doing such. The tax bill he brought up is a very interesting thing about volatility. I am very confident one's going to get done, but one getting done in November versus July versus April is very different for how markets are able to price it in. So this one bill versus two bills in budget reconciliation, that's a big deal for market volatility. It's going to end up happening in the end. We know they have the math. They'll get the votes, but the process is going to be tricky.
Fitch is out today saying we might have to rely on another CR. They're not confident this is going to be smooth.
I think that Fitch is right about that. Yeah. I think they will end up needing another CR. The difference is that President Trump telling the House to accept a CR apparently is going to carry a little more weight. I don't think the CR is a big deal for markets.
David, did you want to weigh in on the sort of leadership rotation question?
I think the defensives have actually not done very well since the year started off, and now today they're kind of in the lead, and I expect to see more of that this year. Consumer staples, healthcare were reasonably laggards last year. They were still positive on the year, but certainly much less than these other technology, consumer discretionary. And 2022 was a very important year where you saw this tech stuff get beat up a bit as interest rates went higher. Those defensives were all positive. And we have a precedent of this in the past when .com imploded. Large cap value did very well. So I don't know if 2025 is that year or not. I know something like that is coming, and it's difficult to time. But staples, healthcare, they're not dealing. They're at 16 times, not 23 times.
Yeah, the relative performance is striking, especially on staples versus the S&P. David, thanks.
Yep.
A lot to unpack today.